In this class, we've been focusing on the long term. So we were thinking about situations in which, for example, labor moves between sectors in the economy, between industries. We said that this might require a long period of time. It might take time to acquire the human capital, the schooling that we need in order to switch from one sector to another. Um, it, it might be not true in the short run that imports pay for exports, but we said in the very long run that it must be true that there's no imbalance between the value of goods and services that are exported and goods and services that are imported. Now that we have in this new part of the class, we're going to relax this assumption of being in the very long run and we'll focus on more realistic situations in which imports and exports of goods and services need not to be balanced. And we'll see that anytime there's an imbalance between these two important quantities, there needs to be a change in financial wealth of nations to compensate for this temporary imbalance. A device that we're going to use to analyze these kind of situations is the balance of payments, which is an accounting device that just records all the transactions that residents of a country have with foreigners. We'll analyze specific entries of the balance of payments. We'll analyze the logic that is behind the accounting of the balance of payments. Finally, we will focus on one particular measure of the flow of goods, services, and income between one country and the rest of the world that can be derived using the balance of payments, which is the current account balance.